This is Neil from Calgary. He's asking, what will it take for Northland Power to start moving the company as a global renewable power company, and reported what looked like strong financial results, yet the stock price keeps trending lower. All right, well, let's take a look at what is going on with Northland Power. First, what does the company do? They're a global power producer established in 1987. They have a focus on renewable clean energy and the energy transition. They have a stock price right now of $20 per share, about a $5 billion market cap, and a yield of just under 6%. The symbol of the company is NPI on the Toronto Stock Exchange. So looking at their operations, they do have a global footprint. This includes offshore and onshore renewable power facilities, as well as a smaller portion of their portfolio focused on natural gas power generation. So operations in North America, in Europe, in Colombia, and in Taiwan. And looking at the stock price over the last month, not really much to get excited about here, just a lot of volatility. The stock price up and down, trending between about $20 and $25. But if we look over the last 5 years, we can see that it's been pretty much a consistent downward trend for the stock price since 2022, 2021. Now, there was a period in the late 2020, early 2021, where there was a high level of optimism for renewable power stocks. I'd say I wouldn't go as far as to say there was a big boom in the space. It was fairly short-lived, but renewable power was very popular at the time. And since then, for the renewable power producers, we really haven't seen any of the companies produce much in terms of good performance. And that's certainly been the case with Northland Power here, trending down fairly consistently for the past couple of years. And then also a lot of volatility along the way as well. But let's take a look at these Q2 results because the listener did mention that these results actually look pretty good. So Q2 2024 financial results, sales were up 12%. Adjusted EBITDA was up 15%, 15.5% actually. And then adjusted free cash flow per share was 27 cents, up 8% year over year. So these are fairly good results at face value. And the question is, what is buried in these results that the market is seeing, that investors are seeing, that cause the market to not be very optimistic about Northland, at least in the near term, and why the share price has performed so poorly. So we'll take a look at some of the factors that were influencing the Q2 2024 results. There was higher wind resource for their offshore wind production facilities. That contributed an extra $20 million to revenue. Now, one of the things about renewable power, particularly hydro and wind, is that their financial performance is going to fluctuate from year to year and season to season based on just the wind or the water resource. So in some periods, it's going to be higher and some lower. That will often affect financial performance because it affects production. And generally over a period of a couple of years, this is all going to even out. So higher wind resource is not necessarily something that we would see as like a recurring area of growth, unless it's the result of, they're getting more production because they're adding on more facilities. That's not the case here. So this is just short-term cyclicality in the wind resource, so to speak. Another thing was the commercial operation of New York onshore wind power projects. This happened in October in 2023. So this contributed in 2024 compared to the previous year. Now, this is something that we would consider to be ongoing contributor to financial performance and growth. There were the EBSA contributions for Northland's EBSA utility due to higher market demand. Again, this is probably just short-term volatility in demand, so not necessarily a function of an increased capacity, although there is some increased pricing in there. But then also very important was the sale of their solar facility, La Lucha. So this actually added $20 million to the adjusted free cash flow figure, contributing to the higher free cash flow for the quarter. Now, this is a one-time gain typically I would say this is not something that I would want to see in adjusted free cash flow. So I would take it out of free cash flow. And if you do that, Northland's free cash flow is actually lower in Q2 2024, significantly lower than it was in the same period last year. Now, the company has provided guidance for the full year. They are expecting adjusted free cash flow to be in the range of 130 to 150 per share. Now, they are saying that they're likely to hit the high end of that guidance. Maybe they even surpass it, but they did not change their guidance after Q2. So this is not a situation where they had strong numbers that exceeded expectations, and those positive fundamentals are necessarily going to continue. In fact, if you look at the guidance compared to what they produced in the first two quarters of the year, they would only be expecting 15 cents to 35 cents in adjusted free cash flow per share for the entire second half of the year. So this is certainly they may exceed their guidance, but at the same time, this isn't a situation where the Q2 results have really improved the outlook for the year, or at least based on what management is saying. And then if we look at valuation based on the $1.50, so assuming they hit the high end, they're trading at 14 times free cash flow. I would say that that's a pretty decent valuation long term, although we also have to consider the lack of growth. Now, speaking of growth, one of the most important metrics we would look at for Northland would be the free cash flow per share, adjusted free cash flow per share. This is really a good representation of the economic value being generated for the common shareholders. So if we look at the company's financial performance on adjusted free cash flow per share going back to 2019, we can see there's really been no sustained growth. It kind of just bounced around between 2019 and 2023. And now in 2024, based on guidance, they're actually expecting a fairly significant decline compared to the previous year. So our take on Northland Power, we like the idea of a globally diversified renewable power stock. It does have a long-term outlook for growth, meaning that they do have a pipeline of projects which they're putting into operation over the next 5 years. And they're expecting about 7 to 10% compound annual growth in adjusted EBITDA from those projects. So that's not cash flow per share. That's just adjusted EBITDA. Valuation is reasonably attractive relative to its historic range. If we go back previous to 5 years ago, it was trading at a much higher valuation for most of its history. But weak financial performance in recent years, particularly even though the Q2 results looked good, they're actually expecting lower results for the year. They have been impacted by inflation, by higher interest rates. This has been a big weight on the company, but really no consistency in cash flow or dividend growth. So not been a consistent grower of the dividend. And then, in terms of just cash flow growth, even before interest rates went up, cash flow just kind of bounced around in a range. There wasn't really an established trend of growth there. So our conclusion is that we're continuing to monitor the stock, but the lack of consistency in financial performance and growth really keeps us on the sidelines. And there's no near-term intention of recommending Northland right now.
Yeah, it's interesting, but like you said, in the near term, if they're even though they're trading below historical multiples, if the near term trend is them to move lower in terms of earnings, it may not be a company that. I mean, we want to see, yes, reasonable valuations, but we want to see growth at least over the next year, 2, 3, 4, 5 in terms of earnings. Maybe you can look 3, 4, 5 years out and forecast growth for Northlands. But again, the forecasts right now don't include that over the next year to 2 years, as I understand. Correct, Aaron?
Yeah, I mean it's the forecast. Their forecast for growth, again, adjusted EBITDA, not cash flow per share. That I believe this is about a 5-year forecast, probably, as these projects come online. But really, the metric again that we're looking at most closely is that cash flow per share. And what I want to see is an established trend in growth in cash flow per share, and I also want to see the dividend growing as well, and that's not something that Northland has been providing.
Yeah, and like the reason why for Northland's a perfect example of why we look at per share metrics is they issued a significant amount of shares when their stock price was high, which is most likely the right thing to do. But you see this across utilities where at times they will issue a significant amount of shares to take on new product projects. It's a capital intensive business, utilities as a whole. So you expect them to do that. But is that's why you need to look at the per share metrics is are those actually accretive on a per share basis? Because at the end of the day, that's what you are receiving as a shareholder
Hmm.
for X amount of shares. You need to look at those per share metrics. So even if the top line is growing, their energy production is growing, if that per share metric isn't going up, you're not really receiving anything more
Hmm.
despite those top lines going up.
No, absolutely.